Welcome back, investors, to Ticker Time News. I'm Adam, and the stock market started the day in rally mode, bouncing from oversold conditions with the Nasdaq up 2.2% and the S&P 500 up 1.7% at this morning's highs. You can see that on this chart here in front of you. This is the 5-minute time frame for the S&P 500, ticker symbol SPX. Big gap up this morning, a rally for the first 30 to 45 minutes, and then things started to turn around, right? A drop in Treasury yields, a weaker dollar, and mega caps. Slow down here. Take a breath. Slow down here for a minute. Mega cap stocks, all of those were supporting factors for the rebound this morning. Each of these supporting factors, though, weakened throughout the day. And as they did, the major indices gave up their gains and spent most of the day in negative territory. The S&P 500 set a new intraday low for 2022 at 36.23, having fallen below the June low of 36.36 in this afternoon's trade. Moves in the stock market were largely driven by moves in the Treasury market. The 10-year yield sat at 3.8% before today's open, but settled the day at 3.96%. The major indices were able to lift off session lows when the 10-year settled, or the 10-year failed to settle and break through that 4% mark. That would be a very significant psychological level for the 10-year to break through and then settle the day at 4% or greater. I think it's a possibility, but eventually these yields are going to turn around. They are going to come back down, which will help provide support for equities. And we'll finally get a bounce instead of a bull trap, right? But still, the sharp moves towards that level undercut the early rebound effort, giving us, like I just mentioned, a bull trap that most certainly trapped a good amount of investors. Another driving factor was the roller coaster action in the currency market. This US dollar is unstoppable right now, and it may just be unstoppable for a little while longer. Let's switch over to the daily view here, not just the 5-minute view. I got to click a button to smooth this out, and look at that. A rocket ship. Even this morning when the dollar pulled back, it didn't stay down there. It popped right back up. The US dollar index, ticker symbol DXY, it traded down to 113 earlier this morning as the euro and the British pound were able to rebound. However, that rebound effort lost its steam, and the US dollar bounced right back to 114, ending the day up 0.1%. I know, 0.1%, that's not a big move here after what we have seen in the dollar. Yesterday, up a percentage point. The day before, up 1.6%. The bigger the rate of change in the dollar, the bigger the S&P 500 falls. Yesterday, we saw it. The dollar moved big. The S&P, it went down big. Today, with the dollar kind of backing off just a little bit, that gave the S&P 500 time to kind of recover a little bit. Stop the bleeding. Go see, make it through the triage phase if you go to the ER. S&P 500 down 0.2%. SPY down 0.26%. The Qs were actually positive for the day, up 0.04%. The IWA, which is the Dow Jones, down 0.5%. IWM, small caps, they were up 3.34%. I said yesterday during yesterday's live stream that small caps, when we get a bounce, small caps will likely be the group that bounces the highest because they've been beat down the worst. So IWM is a ticker to watch when we get a bounce. That is one that could move the quickest. Technology is way oversold. So the Qs are likely to get a big bounce too. Most likely a bigger bounce. Well, I would say a bigger bounce than even the S&P 500. So if you wanted to pick Qs or SPY, which one to ride out a bounce, I'd pick Qs over SPY because there's some developments in other sectors that you have to worry about when you're dealing with the SPY or SPX that you don't necessarily have to deal with when you're in the Qs. The Qs is the Nasdaq. It's more technology focused. There are fewer stocks in that indice. With the S&P 500, you've got all the different sectors to worry about and how they're performing. Oil being down, financials being up, that could leave the S&P 500 nearly flat. But with the Qs, you don't have that to worry about. Just a little tidbit there. I hope you can use that to your advantage. Now, separately from the mega caps, or I should say from the dollar, from the currency market, are the mega caps. The mega cap stocks were unable to hold a stronger line today to keep the markets from going up any longer. The Vanguard Mega Cap Growth ETF, ticker symbol MGK, it was up as much as 2.2% early on, but finished the session flat. The movement in mega cap stocks had a heavy influence on the movement of the major indices. Now, yesterday, I was asked about what sectors may pop once we get the bounce from this oversold condition. And I just wanted to kind of reiterate those sectors. I talked about a couple of them and the reasons for why. I answered the what, but I also answered the why. The what, technology. Why, the 10-year. Treasury market. The Treasury market's got to kind of pull back, flatten out here a little bit in order for the technology sector to really take off and to get a good bounce. So I answered the what and the why yesterday, but I just want to just quickly go through that list. I'm not going to give the why behind the what this time. But REITs real estate, ticker symbol XLRE, materials, XLB, communications, XLC, technology, XLK, and industrials, XLI. Those are the sectors that I think could get the biggest bounce once we can catch a bid and actually bounce. But we got to see this dollar cool off. Like this morning, we need to see the Treasury market cool off, the currency market with the dollar cooling off. Those are two big areas that need to cool off and pull back for us to even get a bounce. I know we're oversold and we can stay oversold for an extended period of time. Going to the SPY here real quick, and then I'll talk about the sectors. When you're oversold, and let me just pull up the RSI here just real quick and look at this. When you are oversold, you can stay down there for an extended period of time. So let me move this map up real quick here, this chart. Go to a wider view. All right, so first off, I want to look at right back here, okay, where this first blue dot is. This is back at the beginning of September. RSI dropped down to a 31, and that was on August 31st. And we stayed under 31 for an entire week. So again, that is totally possible. The next time I want to look at is over here, okay? We first got down to a 22 on the RSI on January 21st, and we stayed. I mean, got down to 18, got down to let's see, there's a 19, a 17, and then finally back up to a 24 by January 28th. So we stayed there for a week, right? So when you're oversold, it doesn't mean that as soon as you become oversold, you have to immediately bounce back, okay? Oversold can stay oversold for quite some time. It can be a week. It can be a couple days. It could be 2 weeks. Just like when you're overbought and you're on the opposite side of the extreme, you can stay there for a while too. I mean, just look at this small area here. I know it's not the greatest example, but here, the RSI, right here is where I'm looking at. On August 11, the RSI was at a 69. It stayed above 60, stayed above 69 until August 19th. So it was overbought for quite some time. Again, that was August 11 all the way to August 19. So another week. Overextended areas, whether overbought or oversold, they can stay there for an extended period of time. One other thing that I want to point out here on the chart is, you know how I like to talk about the markets and their rhythm. Expansion, contraction, expansion, contraction. Expansion leads to contraction, contraction leads to expansion, so on and so forth. It works for any time frame on the chart. And just as a quick reminder, there is a link in the description to TradingView. Sign up, doesn't cost a penny, and you can do the charting right along with us at home. Expansion leads to contraction, contraction leads to expansion. Let's see what that looks like. So we had this expansion of a move down. Then we contracted right here. Then we got an expansion move down. What are we doing right now? Right now, we are contracting. That follows the fact that you can stay in overextended periods for a week, a few days, a couple of weeks. It doesn't mean as soon as you reach oversold, we've got to go back to being overbought and back and forth and back and forth. No. The market can stay in those overextended areas for a matter of time. Okay? So right now, with the past 3 days, it looks like or I should say the past 3 sessions, it looks like we're finally getting some contraction, right? We're going to consolidate here for a little while. Maybe we end up consolidating here for a week, and by the time we get to Friday and we look at what the week looks like, maybe it looks like we've barely moved at all, right? You following me on that one? All right, let's keep moving on. I want to clean this chart up here real quick. Let's go check out the sectors, because most of the S&P 500 sectors were in the red today, but not all of them. Okay, I'll leave it at that. Not all of them. Okay, right hand portion of your screen, you see all of these red and green percentage points over here. Those are your 11 S&P 500 sectors right there. And again, most of them are red, but there are a few standouts. Now, consumer staples, ticker symbol XLP, down 1.8% today. Utilities, ticker symbol XLU, down 1.7% today. Those two sectors brought up the rear of the leaderboard today. Now, on the flip side, we had energy, ticker symbol XLE, up 1.2%, and consumer discretionary, XLY, up 0.3%. They sat atop the leaderboard today. Now, energy outpaced the other sectors by a sizable margin today as oil prices just took off. First, let's look at XLE, which is the ticker symbol for energy. And you can see here, energy hasn't been doing so good. So this overperformance today relative to the other sectors, that was a welcome sign for those in the energy space. Now, of course, if you're shorting energy, it's been a fun ride. But I want to point out this trend line right here. I need to move this screen up a little bit. You know, with everything falling so much, a lot of this price action gets caught up with the volume bars, and it makes it difficult to see. Okay, this blue trend line right here that has caught and gave support to energy right now. I want to go back and I'm going to tighten up this chart here. Give me a quick second. I got to click a button. Now, as I tighten this chart up and we start to look further back in time, you're going to notice this blue trend line. There's some green circles along this trend line. Okay. This goes all the way back to October of 2020. October of 2020 is when this trend line began. The energy sector found support on this trend line in October of 2020. Then guess what? It found support on this trend line September of 2021. Then again, it found support on this trend line in December of 2021. Then there is no green circle right here, but energy almost in July of 2022, energy almost came and touched this trend line, but it stopped short and did not use it as support. Now, right now, yesterday's session and today, we find ourselves in the energy sector sitting right on that trend line. Can that trend line be held, or will we break this trend line? Now, the weekly expected move for energy. Now, I don't usually give these out until Wednesday or later, so our private investor community has a chance to get these every Sunday evening. 40 plus products go out to our private investor community that gives them the weekly risk range for these different products, including the 11 S&P 500 sectors, the main indices like the SPY or the Qs, the IWM, a ton of subsectors, and a bunch of mega cap growth companies as well. Energy being one of them. The lower expected move for energy is 66.05. The upper end for energy is 74.91. If this support can be held, the blue line, if that support can be held, then we may find ourselves sitting right in the middle of the weekly expected move in energy for this week. Now, for this to happen, for the energy sector to stay above this trend line, what we need to see is we need to see oil continue to rebound. Now let's look at it. US oil, real easy ticker symbol in TradingView to remember. That takes you to WTI crude oil futures. It settled up 2.8% today to $78 a barrel. It is up about 0.5%, maybe a little bit more in the after hours. Now, $85 was a support area. It seemed to be holding, but that gave way, right? September 23rd was the big sell-off in oil where it lost 5%. Now it is sitting pretty darn low, but it has seemed to have found support right around that $76 to $77 a share. Or I'm sorry, not share, per barrel. If that could hold, and if oil could get a little bit of a recovery here, then the energy sector could stay within its weekly expected move and hold that trend line support, that blue trend line support. So oil is going to play a critical role in whether or not energy can do it. Now, moving on in today's market, there was a whole bunch of Fed speak. And that Fed speak was a little bit, I should say, it was sending mixed messages. Okay? There were mixed Fed speak messages for market participants to digest today. Chicago Fed President Evans, who is not an FOMC voter, acknowledged to CNBC Europe that he's a little nervous that the Fed is moving too much too quickly. But he added that he remains, quote, cautiously optimistic that the U.S. can avoid a recession. Now, I don't know if we're really gonna avoid a recession because we're technically in a paper recession. Okay? And since we're technically in a paper recession, can a Fed official say that we're not in a recession? I guess they can. They change the definition, do whatever they want. We know what's really going on here. Now, in contrast to that, we've got some more hawkishness. Cleveland Fed President Mester, who is a 2022 FOMC voter. So what Mester says is pretty important. And Mester said that policy rates need to be at a restrictive level for longer to bring inflation down and to make sure that inflation expectations do not move up as well. So there's a hawkish comment right there. Now, to add on to that, St. Louis Fed President Bullard, who is also a 2022 FOMC voter, said the U.S. has a serious inflation problem and that the credibility of inflation targeting is at risk. Now, that was according to a Bloomberg report. We didn't get to hear that ourselves, but that's a quote. Now, to stick to this topic of the Fed, I'm going to pull up our Twitter account here, and this is a tweet that we sent out today. Lyft. About Lyft. Lyft slides on reports it is freezing all U.S. hiring through the end of 2022. And that's according to a New York Post article. And then here with it, Uber ticked lower because of that news too. This is just another signpost pointing out our slowing economy. A hawkish Fed tightening and raising rates into a slowing economy, to my knowledge, has not been done before. So how can the Fed possibly look us in the eye and say there's still a chance for a soft landing? No, dude, the plane's going to crash, okay? We all know it. Don't sugarcoat it for us. I wish the Fed was a little more straightforward in its Fed speak. That would make it a lot easier, and it wouldn't have some investors with their eyes glazed over thinking that we're going to the moon on the next bounce. We got to be realistic and stay realistic. All right? We buy from the pessimists and we sell to the optimists. That's the realists and traders. At least the good ones, that is. So stay realistic. Now, looking at today's economic data, first up was the August durable orders, which fell 0.2%. The expectation was a fall of 0.1%. So fell twice as hard, even though that's just a percentage point. Now, durable orders excluding transportations rose 0.2%. So it's transportation that's holding it back. Now, the expectation here was 0.3%. So again, a tenth of a percent difference on the lighter side. So the key takeaway here is spending held up pretty well. That point resonated with the 1.3% month-over-month increase in non-defense capital goods. That also takes out aircraft. And that came on top of a 0.7% increase in July. Okay, so there is a bit of expansion, even though it's relatively small. Then the September Consumer Confidence Index, it rose to 108. The expectation was 105. And the prior reading last month was 103.6. So the key takeaway here is that the increase in confidence was bolstered partly by consumers' views on jobs and wages, because the overall job market is holding up pretty well. Although we're seeing signs that the job market is slipping, especially when you see reports like Lyft freezing their hiring for the rest of 2022. That's a whole quarter to go. 3 more months plus. We got the rest of September, October, November, and December. That's just over 3 months of no hiring, unless something dramatically changes. So that view on jobs and wages, that could be a good omen for spending, maybe. Yet it would not help mitigate concerns about the Fed tightening. given the Fed's belief that there needs to be some softening or some pain in the labor market to help tamper wage-based inflation pressures. So, a couple things working there on consumer sentiment. Next up, we've got a whole bunch of housing market reports, including some tomorrow as well. But here's what came out today. New home sales surged 28.8% month over month in August to a seasonally adjusted annual rate of 685,000 units. The expectation, like we mentioned in yesterday's live stream, was 500,000. And the prior reading of 511,000 was shifted up to 532,000. And that would be 532,000 units in July. Now, on a year-over-year basis, new home sales were down 0.1%. The key takeaway here is that new home sales were much stronger than expected. I have to give them that. It was aided by a sense of urgency to sign contracts as mortgage rates came down. This strength, however, is apt to be a distortion given the surge in mortgage rates that has occurred since the ensuing period. Rates, we've looked at the 10-year, we've looked at the 2-year, they are spiking. What does that do to mortgage rates? It also causes mortgage rates to increase. Let's see here. Don't want to miss anyone's comments. I'll give you a view because how it feels. Great advice and no viewers. Keep it up, brother. I'll give you a view because, yep, I greatly appreciate that. I do. We usually have a wild party around here. The redder the days are, the more viewers we get. The greener the days are, it's the less viewers we get. So I do appreciate that. I really do. Thank you very much for that. And I greatly appreciate you. For sure. For sure. All right. Another piece of housing data that came out today was the July FHFA housing price index. It fell 0.6% after the prior reading was a 0.1% increase, right? And then we also got the July S&P Case-Shiller Home Price Index that came in at 16.1%, but the expectation was 17%. After the prior reading of 18.6% in June. So you can see a pattern there month by month. We go to June, 18.6%. We go to July, 16.1%. You see the pattern there? Even though that's just 2 months. I could go back another one. So this is on the S&P Case-Shiller Home Price Index. It came in at 16.1%. This is showing the growing weakness in the housing market. Now, looking ahead to tomorrow, Wednesday, market participants will receive the following economic data. At 7 a.m. Eastern, we get our normal weekly MBA mortgage index that came in last week at 3.8%. I'd suspect possibly a little gain there. Just because of the way mortgage rates have been bouncing around. But this latest move this week with the spike in the 2-year, the spike in the 10-year, that's going to cause this to drop significantly in the coming weeks. Then at 8:30 a.m. Eastern, we get the advanced retail inventories. The prior reading was 1.1%. Can we keep it there? I think inventories will become a problem. They already are a problem for a lot of retailers. And remember, when there is too much inventory, that puts pressure on margins because inventory can get lost, misplaced, it can get stolen, it can get damaged, it can get dusty and dirty, and then you got to sell it for a discount. So excess inventory does pressure margins. Just keep that in mind. And then we also get the advanced wholesale inventories. The prior reading was 0.8%. Then at 10 a.m. Eastern, we get the August pending home sales. Now, this is more of a barometer than existing home sales because this is a forward in the now looking data point. Now, the prior reading was down 0.1%. Let's see what that comes at tomorrow at 10 a.m. Eastern. So, not a lot of drivers there for the market. So, this contraction that we're seeing in the market right now, this could be a good sign that, hey, if the market can hold this contracting phase, if it can hold on to this phase of consolidation, then maybe we could see our bounce from oversold conditions. I do need to put a little caveat on that right now. The longer we consolidate, the longer we move sideways, eventually this oversold condition, it'll start to level out a little bit. You know, like you're flying a plane, you're that is how this might work. So just keep that in mind. Now, if it does consolidate and contract right here, and we don't really go anywhere, you know, 1% up, 1% down, but we're just kind of staying here, I think that does set up for a potential, and again, we're not seeing it yet on the daily time frame, but we could potentially see a bear flag forming, okay? On the 15-minute time frame on the Qs, there was a bear flag forming earlier today. I haven't checked up on it since then, but just real quick, let me run through the numbers. I've reached the end of my notes for today. Let me go through these numbers real quick for where I think the low might set in at. If we get one more leg down before we get into October, or maybe the beginning week of October, because remember, Friday is the last trading day of September. So we're going to see a lot of volatility on Friday because it's the last day, not just of the month, but also of the quarter. Okay? So we've got a double whammy there. All right. So for the SPX, tracking the SPX, you know it. It's this yellow line here that I'm highlighting in blue at 3,500. For the SPY, it is at 350. That's where I think the low could set in at. If we get another leg down, either because of Friday's volatility, or, you know, just being the last week of September. There's also an orange line right there. I can highlight it in blue. That's right there. You notice these both for the SPX and the SPY, they're just under a little bit, 5 points here for the SPY for the weekly expected move. Now, for the Qs, let's open this up. For the Qs here. Oh, I thought I got rid of that marker. I did get rid of that marker. So why is it doing that? Must be a little bit slow right now. All right. So for the Qs, it's at 260. The weekly expected move is 260, right? So one more leg down for the Qs. If we get it, that's just going to put it right here on the weekly expected move. All right. So make sure you jot these numbers down because those are important support levels for these different indices. And then last one here is IWM, which are your small caps, just like the Russell 2000. But here also just below, and let me move this out of the way. That was a yesterday topic. For the weekly expected move, it's 160. And the support level to watch out for is 160. So the lower end of the weekly expected move for the QQQ and the IWM is that important level. 160 for IWM, 260 for the QQQ, 350 for the SPY, 3,500 for the SPX or S&P 500. Those are the very important levels to make sure you are watching for strong support. All right. Now, you know, in my investment thesis, if that 3,500 level gets broken, I think we can go down to 3,275. And I've got my research to back up that number. It's not just something I'm pulling out of thin air. All right. So that, my friends, is all the notes that I had to go through. Now, before I wrap up this live stream, if you got any questions, plug them in now. Otherwise, can you please do me a favor? Click that like button, share this video with a friend, and consider joining our private investor community. Just click the first link in the description of this video. You'll get instant access to our weekly expected moves, numerous trade setups, and 16 different trading strategies, top 10 stocks in 4 different categories like value, dividend, growth, and momentum, economic and market insights, and of course, a private Discord server, all to help you along your investor journey to gaining knowledge to become a better investor. I myself, I learn every day. I am constantly trying to become a better investor, a better trader, to achieve that goal, just like for you, financial independence. Oh, and if it's your first time watching, click subscribe. All right. If there are no other questions, I will wrap it up here, ladies and gentlemen. Thank you for being with me. I greatly appreciate your time and effort watching these videos, listening to me, hear me out for what I have to say about this market. And I'll be back here tomorrow after the market closes to talk about what happened, why it happened, and what to expect going forward. All right. Thank you so very much for watching. And I'll see you in the next video. Take care.